Now, as we turn to the U.S., it's important to appreciate how, what real estate means for not only just the U.S., but also in other areas, because the real estate side for years, I mean, you can go back decades. People have, centuries even. People that buy real estate, it's, especially if you build apartments on them, cash yielding, everybody wants to own, as my father would always call it, a piece of the rock. And when you look at that backdrop, that's always been a mantra of safety. That's always been a place that has had a lot of opportunity. But things get cloudy. Things get warped, and ZIRP, or those zero interest rates, makes it very difficult because then people model things that don't make sense at prices that don't make sense, because rates are free, rates are cheap. This is going to happen in perpetuity. And it's interesting now because when you look at PIMCO and Brookfield, they defaulted on $1.7 billion in mortgage notes, which again was a quote unquote shock going to hit the real estate market. But for those that have been following us and how we've talked about real estate, that really shouldn't be surprising. Like, that was always bound to happen given the economics of entry. And for anybody that's ever done real estate, entry price matters the most. Where you enter and where you exit is always going to be paramount. And if you enter at the wrong price, it's going to be really difficult to make that up. And when we were with my PE fund, we do the same thing buying hydroelectric dams. If you get in at an expensive price with the idea that you're going to rely on the forward curve and electricity prices going up, that's going to be a problem. Because if we're wrong and electricity prices don't go up, well, how do I make sure that I covered myself, which is why entry point is so important. So then when we turn around and we look at where things are here, when you look at the looming maturity, so $92 billion of non-bank finance debt is set to mature this year. And this is when people aren't going to the office. 40% of the country is still not going in. You still have rates going up, and you have a Fed that is no longer going to support these high level asset prices. They so far haven't done a lot. Obviously, they've raised rates to bring it down. They still are sitting on a lot of mortgage-backed securities that have yet to come into the market. But now when you take that to the next step, Blackstone defaulted on 531 million euro of CMBS, or commercial mortgage-backed securities, after the property sales were delayed because they don't have the cash. So you have all of these funds that are big and thick and safe, but they use leverage just like anyone else uses leverage. And they were leveraging with the idea that some of these prices weren't going to come down, that you were going to have rates at zero forever in Europe, in negative. And now that's unwinding, and it's unwinding quickly. And unfortunately, nobody listened to me in 2020 when I said that this was coming. Then in 2021, people argued with me with how high it was going to go. They didn't believe it was going to go this high. And here we are. So now the next chart that I constantly refer back to is the purchase only house price. And it's only just gone sideways. We haven't even seen this meaningfully come down, and wages are just kind of bumping along. At some point, they have to meet again, they don't have to marry each other, but they cannot stay at these levels without creating some sort of bigger disconnect, because who can afford this next level, especially with rates going up, which is why those prices have to come down. And the Fed is adamant about doing it. Now, when you look at the U.S. Market implied terminal rates, it's at 5.4%. And now I actually agree with Nomura here, and you can see how they've outlined it. So they see a 50 basis point hike, 25 to get to 5.75%. I think that's a fair estimate. I think that now I obviously disagree with some of the speed in which it comes down, but you can see even they're holding it constant for 2023. I would say that it's constant for 12 months, not so much just for 2023, then starts to come down in 24. I think there's a much longer period in which we stay here. But again, I think that 5.75% is now probably more of a reality than even I assumed. I thought we would get to about 5.5%. that, as those that follow me, I said the last couple of weeks, as the inflation data came out, jobs data came out, that I went from a range of 5.25 to 5.5 to 5.5 to 5.75. And that's why I think this is the market is starting to see what we've seen, and they're starting to adjust. And here's where, when you look at the recessions, real personal income, X transfers, when you look at the 6-month annualized percent change coming down, personal savings kind of just bouncing along here. You had a little bit of a bounce off the bottom, but wages came up a touch. You had some slowdown in spending, even though more of it was on credit, but nothing goes down in perpetuity. There's always that balancing act back and forth. Now, when you look at the 3-month annualized percent change as of the different periods, you can see just where we are in terms of 2023. There was a hope that a lot of these numbers, especially on the CPI, core CPI, PCE, that they were going to go down. But when you look at October of 31 versus January of 31, there hasn't been a whole lot of progress. There's been some, I'm not saying there hasn't been, but on core PPI, core PCE, they're not seeing what they need to see to really adjust policy. And that's the biggest concern that I have when you look at economic growth, asset valuations, and where this is going to continue to fall. So climb in personal savings rates was somewhat typical in recessions, but that is usually met with significant deterioration in real income growth, which we have not yet seen. Personal savings rate continued to climb a touch to now to 4.7%. For 6 broad inflation metrics, 3-month annualized percent changes have all eased from 6 months ago, but PPI has reaccelerated from 3 months ago, while PCE hasn't slowed as much as CPI. But remember, PPI is more of a leading indicator for where CPI is going, which is why when you start balancing these pieces together, it's difficult to see how we're going to get growth. I have said from the beginning, it's not that we're going to see this massive decline in GDP growth in the U.S. where we're down 15%, but it's going to be hard to see how we're going to achieve growth. It's more around, are we going to be minus 0.5, minus 1%? That seems more likely. Non-housing core service PC inflation, again, breaking into its pieces. The FOMC is very focused on the non-housing core service PC inflation, or as they call it, supercore, which registered its biggest monthly increase in over a year. Again, not a position to slow things down. And then what drove it? What drove that top line? Services. As we've been saying from day one, service cost is sticky. And that is and 70% of the U.S. economy is service-based. We are not going to see that reduction quickly, and that's going to be a continuous headwind. And one of the interesting things is the top 5 subcomponents remaining contribution. It's so broad-based at this point that you're still seeing a broad basket of increases, which is going to weigh on just policy in general. Red dashed lines mark starts of prior Fed tightening cycles. This one is unique given it started with very strong year-over-year growth in payrolls, similar rates seen in the 70s and 80s. Again, when we had a wage price spiral where we had a lot of problems. But after that, more common for Fed to start hiking when payroll growth was relatively softer, but still above zero. So when you look at the likelihood of where we sit, you get an idea of where we're going to go and how that's going to continue to play out on the non-farm payroll side. And as we said, it's very similar to the 70s. And what was happening in the 70s? You had a fairly large shift in the market in terms of where production, manufacturing was going. You had the baby boomers coming in. You still had a fairly sizable amount of retirements. You had a lot of union jobs. You had a lot of things that were keeping some of these pieces elevated until you saw a bit more of it, that extensive exit going and sending manufacturing into other countries. Now, when you take to another key level, the month-over-month change in national rent index went higher. So that's an underlying problem. You actually had an increase in rents again. We should be seeing not so much a steady, hitting at a consistent 1%, but we're starting to see the pivot back up. That's a problem. Now, when you start looking at trade-ins, for trade-in cars that carry negative equity, the average amount is approaching pre-pandemic levels at $5,500. Surge in prices and prevalence of 84-month loans fueling concerns among those within the auto industry. So there's two sides to this. So now that means that if you go to trade in your car, your car is going to be $5,500 below what the remaining is on that loan. So now you have an issue, because how do you essentially get a new loan? Well, what they're doing is they're taking what you owe on your previous and rolling it into your new one. So again, just trying to keep this churning, this merry-go-round going, which, as we've said, is a huge problem, and it doesn't happen all at once. It never will, never does. I may say it's going to happen in June of 2023, and it might happen in November of 2023. It's near impossible to nail it down, but you can see the trend. You can see the movement. You can see the pressure. This is what we've been trying to say. We're not sitting here going, all hell is breaking loose, buy guns and ammo, store up on rice, beans, and bottled water. No, it's just, this is a problem. And this is a problem that we've seen it before. It happened in '08. We've seen, and this is the problem where, when you talk about how history doesn't repeat itself, but it rhymes. And this is a rhyme. And that's something that we like to point to and highlight. So firms have difficulty passing through cost increases. So they keep trying. In the next segment, we're going to talk about how we've actually seen another acceleration in input cost and input pricing, and how that's trying to go down to the consumer. And that's inflationary. When you look at PPI final demand, when you look at unit labor cost went back up. PPI final demand, it's come down, but it's still increasing. Unit labor cost going up. So again, both of those pieces are showing that you're, again, not when you average them out, you haven't gone up or down, but that's the stagflationary backdrop. That's where we continue to see a lot of these underlying problems. Now, when you look at the construction, payrolls have been strong as of late, but momentum has been concentrated in non-residential as opposed to residential. And just based on the backlog of building, not really going anywhere, keeping prices elevated. Strength in retail sales has kept upward pressure on sales inventory ratio, which is still incredibly high versus history, but inventories continue to climb. Now, when we look at ISM, manufacturing ticked up slightly to 47.7, but the estimate was 48. So better than 47.4, but again, just kind of, and again, that is steep contraction. We're in contraction. There's no question about a contractionary backdrop with that, but manufacturing is 30% of the U.S. economy, round numbers, versus 70%, which is service. New orders bounced to 47, while prices paid jumped back into expansion. Manufacturing is now, again, raising prices. Employment dipped back into contraction. So again, new orders bounced, but still at 47. And as we talked about, and as we'll talk about, the different levels, this is just one data set. And that's why we talk about the noise that can exist between 48 and 52, and how you can get some movements up and down. But 47 is a real number. It's showing you where the new orders are, and it's an indication of continued pressure on the underlying economy. U.S. contributions to the headline manufacturing, ISM manufacturing rose month over month, but stayed in contraction. Production contracted while new orders fell more slowly. Employment declined, but respondents noted that they are trying to maintain staff levels. So again, it's just that no one's hiring new people, but they're trying to keep who's there because costs are still elevated, keeping people there. You can, again, reduce turnover. And if you reduce turnover, so if you have someone who has been in your facility for 3 years, they're efficient. They're more efficient than someone that you have to hire. So yes, I may save money hiring someone, but what's their efficiency ratings? What is there going to be their production value versus someone who's been there 3, 5, 7 years? And that's why they're trying to manage this, which is getting difficult just based on price. And here just gives you the level. And one of the things that we've been trying to really highlight with the PMI numbers as we get deeper into them is trend. They're showing you trend. And they're showing you how is that trend moving? Are you getting a change in it? Or do people feel better about their situation or worse? And the production side is showing you that there's that pressure. New orders, not as bad as it was, but still not growing. You're still not seeing enough to see a company expand. You're not to see, or the economy expand. And nothing goes down in a straight line. We've seen these bumps back and forth. And that's the important piece where we're just going to be stuck in this contractionary backdrop. Prices paid accelerating, went from 46.5 was the expectation to 51.3. That's a meaningful jump, just given what they're trying to achieve, given what's happening, and another backer for where inflation is really heading. It's just they've seen it say, look, we're going to try to raise pricing. It may not stick, but they're going to try, and that's going to, again, put more pressure on the economy, more pressure on the consumer as employment kind of waffles around these levels. Then when you look at the production component, has fallen further into contraction, but look at where it's in relation to. It's in relation to 2019 when we started to get bearish, for those that have been following us. It accelerated in 2020. And obviously you look at 08, you look at 01, 2000 to 01, you're getting an idea that we're not in good company in terms of where things are headed. January construction spending came in at negative 0.1 month over month versus the estimate of positive 0.2. But again, flatlining. It's not like we're getting this huge move. And that's where, the trend is that some of that flatlining on construction spending. January PC came in at 0.62 versus the estimate of core, and then core came in at 0.57. Strongest gain for both series. And again, this is the biggest concern when you look at policy. That's where people are going to put their and focus on the most. Then you look at some current revisions. Revisions for fourth quarter of 2022, unit labor costs up to 3.2% quarter over quarter annualized versus an estimate of 1.6% and 1.1% prior. That's a huge number that companies have to absorb, which is why we see, again, more of that pressure on pricing coming down the line. Productivity down to 1.7% versus the estimate of 2.5%, and the prior was 3%. So people are less productive, costing more. Looking at Indeed job postings by sector, high-skilled vacancies have been harder to fill and remain posted on the site longer. Postings for bottom 10 sectors, all in the blue, have eased over the past 6 months. So again, some of that bifurcation versus skilled. Are you willing to pay for skilled, and what people are willing to accept? Then you look at U.S. real spending. Estimates for 1.1 came in at 1.1. Real spending against the trend still remaining fairly strong. And that's some of the different pieces that we're seeing, and that back and forth with when does the consumer really start to break down? And that's always a hard one to see. Real disposable income coming back up, obviously well off of trend, and we don't really see it changing. But the thing that we get concerned about is the debt service ratio minus consumer credit versus household savings. And you can see how it's blown back out. Still not at extremes, because people did have more in savings. People now have technically more asset value based on where things are. But that alligator mouth creates a problem. And that problem, again, it exasperates people's financials, and it can be maintained for a certain amount of time, but at some point it cracks. And with rates going up, now you have credit card rates the highest they've ever been. You have the credit card debt the highest it's ever been. So sure, your home is not as expensive, but rent is getting more expensive. Cars are getting more expensive. And now you have credit cards getting more expensive, which is going to weigh on some of these key pieces. And this is just breaking into the components, but look at the log scale of personal income. And you look at just where things are. It's like, sure, it's bounced, but you're coming off of lows, and it's important to put into perspective just how far off of normal we are as inflation is actually re-accelerating higher. Merchant wholesale inventory surprised to the downside, which is good when you think about kind of pulling some of that inventory in, increasing orders, while retail inventories have increased. Survey was for 0.1, came in at 0.3. And that's that balancing act, because if retail inventories are flat, you're not going to get a huge amount of orders from merchant wholesalers. So are merchant wholesalers just trying to kind of manage things, and they want to pull down some of this inventory, maybe try to be, specific as to when they buy, but people are sitting on very expensive inventory that they're trying to cycle through. Durable good orders were expected to be at negative 4%, came in at negative 4.5. Transportation equipment was the biggest driver of it, coming in at negative 13.3. But again, a lot of that can be lumpy on the transportation equipment, but it gives you an idea that there's really nothing that's driving us higher. Merchant wholesale inventories, when you look at the flows, you've had a lot of builds, and now you're starting to see some of that come down, and there's a certain amount of that balancing act. So it's the largest contraction since June 2020, but put it into context in terms of where some of those numbers are and where they're going in general, and what those new asks are going to look like in terms of new orders, which are still going to be slow to come by. So that's what we have for you on this piece. In the next segment, we're going to go deeper into some of the leading indicators and regional Fed data, and why we see some of these issues persisting.